Hello, everyone, and welcome to this portion of the ABCs of HOAs. Our topic for today is investing reserves. My name is Barro. I am the financial controller for HOA Organizers. I'm also joined by Lindsay Biren, the VP Regional Account Executive from First Citizens Bank.
Thank you so much, Derek, and thank you so much to HOA Organizers for putting this together. I'm so happy to be here and share my HOA banking expertise with you today. What you're going to hear during this segment may sound a lot like gibberish to a lot of you here today, but it's important that you hear what we're going to talk about and you make a plan for investing your reserves and helping them grow. And remember, you are never on your own. It's always a good thing to trust your experts.
Before we get to the investments, I think it's important that we better understand reserves first. As many of you are aware, with HOAs, there are operating funds and reserve funds. Both operating and reserve funds are generated from the collection of homeowner assessments as outlined by your annual budget. It is important to note that the reserve funds are to be kept separate from the operating funds. Having these funds separated and in different bank accounts helps prevent the commingling of funds. Operating funds are used for routine and recurring expenses. They are intended to address the short-term needs and obligations of the HOA. These are going to be your most common expenses, such as landscaping contracts, utilities, and insurances. Reserve funds, on the other hand, are earmarked for major repairs, replacements, and improvements of the community's common elements. They are designed to address long-term planning and to ensure that funds are available when major expenditures are required. Some examples of reserve expenses would be roof replacements, repaving the roads, upgrading the elevators, or renovating common facilities. It is important to note that the reserve expenditures require dual approval or dual signatures by the board. Davis Sterling recommends HOAs have a reserve funding plan. The association and management of reserve funds are often guided by the reserve study. The primary purpose of a reserve study is to facilitate long-term financial planning for the HOA. It provides a roadmap for addressing future large-scale repair and replacement needs, contributions and expenditures over time, and helps the association avoid financial crisis and possible special assessments. The reserve study guides the association in managing the reserve funds effectively by providing insights into the timing and the amounts of future expenditures. It enables the board to make informed decisions about reserve fund contributions, expenditures, and investments. Well-managed reserve funds contribute to the long-term financial health of the HOA. Having adequate reserves can prevent the need for special assessments or loans in case of unexpected expenditures. Being well-funded instills confidence in homeowners as they know the association is financially prepared for future needs. It can also be a determining factor in the decision-making of potential buyers when homes or units are for sale. As reserve funds accumulate over time to address future expenditures, it provides the HOA with the opportunity to leverage its funds for potential returns from investments. HOAs can be somewhat restricted in their investment options. The HOA's governing docs can limit investment options, so it's a good idea to be familiar with them. In California, the Davis Sterling Act doesn't explicitly outline specific investment options. However, it does impose a fiduciary duty on the HOA board members to act in the best interest of the association. It encourages a conservative approach to financial management. HOAs are often advised to choose investments that prioritize the safety of principal and liquidity, aligning with the conservative nature of reserve funds. According to Davis Sterling, prudent investment of reserve monies should focus on the following parameters in this specific order of importance and emphasis. Number one is safety. A board's primary goal should be the preservation of the association's reserves against any type of loss. Number two is liquidity. Liquidity refers to the ability to quickly convert investments into cash. And number three is yield, which is the return received on an investment. While yield is an important factor in any investment strategy, it should not come at the risk of the safety or liquidity of the reserve funds. When investing, it is important that you keep in mind the FDIC insured limit of $250,000. That limit is for all the combined funds held at any single banking institution. However, there are investment strategies that can allow you to have all your HOA funds be managed by a single banking institution. Lindsay will touch on this in more detail in just a few minutes. The following are the most common and widely used investment options for an HOA. A money market account, CD, an ICS, and a CDARS. Now, don't worry if you don't know what all those options are, or what is the best option for your HOA. Luckily, we have Lindsay here from First Citizens Bank to help shed some light on what each of these options are. Lindsay, I will hand things over to you.
Oh, great job. So when working with your HOA board and managing agent, there's typically a flow of information to help determine what the best investment is for the monies that you are looking to invest. They gather their rate sheets from us, and we look at if the money needs to be liquid in less than 3 months, or if it needs to be FDIC insured above the $250,000. And then we also look at the yield and how long you can put that money away for before you're going to need it. If these funds do not need to be liquid within 3 months, then we recommend placing them into a certificate of deposit, or a CD, as you may commonly know it as. These funds can be placed in all sorts of different types of terms and different yields. The minimum amount required to open a CD is $1,000. So you can place money into multiple different CDs at different rates and terms, or if you are already at that $250,000 limit with one HOA-centric bank, you have another option as well, and that is called a CDARS. CDARS is short for Certificate of Deposit Account Registry Service. This is just like opening a CD, however, it has an additional FDIC protection. You can be protected up to $50 million in FDIC protection. So essentially, you can have all of your money in one HOA-centric bank and have liquid funds and ICS, and have other funds that are going to mature at a later date with a higher yield, and a CDARS account. You only need $10,000 to open up a CDARS, and we have multiple different options available for these types of investments. For example, we have a CDARS ladder. In a CDARS ladder, for example, if you have $300,000 to invest, then you can open up a CDARS ladder. This is a fantastic option for an HOA to consider. The reason being is that there are multiple maturity dates. In this example, we have $300,000 and there are 3 maturity dates. First is 13 weeks. That's pretty quick. So if you need your money in around 3 months, you're going to have that, or within 6 months, and the rest will be a year. The only caveat is that you have to place equal amounts into the CDAR. So in this example, we would place $100,000 into each level of the CDAR ladder. So at 13 weeks, you can decide what you want to do with that money. If you need it liquid to pay for some bills or some unforeseen circumstances, you can pull that money. However, if you can continue to invest it, then you can make decisions to place it into a new CDARS. And at that time, you can determine what amount of time you'd like to place it for. If you miss the maturity date, which doesn't happen all that often, but every so often it does, don't worry, because it will just roll over into another 52-week CDARS for you at the highest possible rate. Sometimes we have active board members who are very interested in getting the highest possible yield rate return. And so when they're out and about and they see their local branches offering promotional rates, they get super excited about placing some of their HOA funds into these promotional rates. But there's something to keep in mind here. These rates are typically presented for consumers. Consumer rates and commercial rates are actually quite different. It's unfortunate, but HOAs are unable to get the same level rates that consumers can receive. Another challenge of moving money to different accounts, specifically branches, is that branches require for all of the signers on an account to be in the branch at the same time. This can mean arranging schedules and potentially losing time on the weekend. It can be inconvenient for everybody. Another issue or setback, another setback that can happen when opening up at branches is that if someone's on the board and they move away or they're no longer on the board, you don't have access to have them go to the branch. When working with an HOA-centric bank, you don't run into these issues because we use digital signatures and we have ways around the flexibility of being able to make decisions on accounts. Keeping all of your money in an HOA-centric bank with your managing agent not only helps the current board and future boards, but it also helps your managing agent with keeping tabs on what your accounts are doing, when maturity dates are coming, and updating signature cards as needed. When an association opens up an account with an HOA bank, we require the association's legal name, tax ID number, and articles of incorporation, as well as 2 signers to sign the signature card. Most managing agents are already signed up with HOA-centric banks. This allows us to easily open up these types of accounts with something as simple as an email. It's important to work with a managing agent that is on top of their community's account type needs and managing maturity dates. Having a team of professionals to keep things organized is key and makes everything easier for everyone.
Thank you, Lindsay, for providing the added insight into these reserve investment options. I think it is important to also point out that any interest that is earned from these investments is taxable to the HOA. That interest will be identified and included by your CPA when they file your tax returns. As we've been discussing reserves and the options available to the board for investing, I also wanted to touch on the different board investor types. In my years of being in the industry, I've noticed that there are typically 2 types of board investors. Lindsay alluded to one of them earlier. There are passive investors and active investors. Passive board investors typically rely more heavily on advice from financial advisors and tend to keep their investments the same, where they renew or roll over until the funds are needed. Active board investors tend to like multiple options to help them make their own informed decisions. I've had some that will establish a reserve fund policy that outlines how funds will be invested and used. And some boards may appoint a finance committee that can help recommend investment options and terms, as well as keep track of maturing CDs and changing interest rates. Either type of board investor is perfectly fine. It may come down to the time and resources you have available. The key is to just start the process. If you have any questions or need help, please reach out to members of your HOA management team and financial advisors. We would be happy to assist you along the way. Hopefully now at the end of this section, you will feel you have more information, access to resources, and that there are less of those blah, blah, blah portions from the cartoon at the beginning of this topic. Thank you all for your time, and we hope you enjoy the rest of the ABCs of HOAs.